Revenues, however, have seen a growth of 19% on a year-on-year basis. To talk about the outlook, we're joined by Amit Agarwal, the Executive Director, CFO of DCM Shriram, on the show now. Amit, morning. Thanks for joining in. This is Reema here. Could you talk about your vinyl segment? It's seen a drop in revenues, EBITDA. What has led to it, and what are the current margins and prices?
See, the vinyl business, yes, has come off its peaks, historic peaks, I would say, from about 40% margins to about 10% margins in Q3, largely led by a decline in prices, which was essentially a function of global decline in demand. However, now the margins are improving. So I think going forward, it should be better quarter.
You said the margins are improving in the vinyl segment. By how much have they already improved? And is there no visibility of getting back to those peak margins of 40%? How much better can it get from here on?
Yeah. So see, 40% was a historic, I would say, abnormal peak, right? But the average margins, if you see a long-term trend in this business, is close to about 25%. Q3 was about 10%. Currently, we are nearing about 15%. And so let's see how it pans out in coming quarters, how the global demand improves on PVC. And therefore, the margins should improve.
Okay. Sir, also talk to us about the chemical segment, because that's where the revenue is higher by about 3%. But there's obviously been pressure on the operational level with the EBITDA sort of not really matching up. Tell us what the outlook is. Also, keeping in mind that China is finally opening up for business. What do you see that sort of doing to your business over the next, let's say, quarter or so?
See, in chemicals, it is, if I talk of India, it is more to do with the new capacities that have come in. That is point number one. Right? About 1 million ton of capacities got added in last 9 months, and some are getting added in next 3 to 6 months. Now, that is obviously increasing the supply in the country. That is point number one. Second, which is putting more pressure, I would say, is the cost, because the energy prices, we are not seeing them coming off. They've been elevated, and we do expect them to be elevated in the coming quarters as well. So that is what is putting pressure. In terms of your question on China opening up, see, it's a global market. I don't think China opening up will impact specifically on India. On global trade, it has already been impacting. It is exporting more to Europe, which is closer. So that impact is already there.
Right, got it. Amit, good morning and thanks for joining us. This is Pavitra. You know, on the chemicals business, you've also mentioned that expansion projects are on track, but the timelines are a bit stiff. Can you, elaborate on this? Are you expecting some kind of delay over here?
So we are targeting to complete all our expansions by Q1 of next financial year. But what I mean by stiff the timelines is that given that there are supply chain disruptions, given what we have seen in China, where there was COVID-related lockdowns, and therefore it has impacted the supply chain across the globe. And we have capital equipment coming from overseas. So we do see some slippage, maybe of 1 to 2 months, but we're trying to pull it back.
Okay, so Q1, Q2, FY24 is when your expansion in the chemicals business should get completed. So this is going to be one avenue of growth, right, for you, the expansion in the chemicals business. You also have cash on the books of close to about 100 crores, and you are actively looking for more avenues for growth. Could you elaborate? Is it inorganic? Are there acquisitions that you're talking about?
Yeah. So one, the cash on the books is close to about 1,500 crores. Right, and we have a debt of close to about 1,400 crores. So therefore, the net, what we mentioned in our numbers was that we have net surplus, net debt of a positive 100 crores of cash that we are having. Now, see, we will be completing our capital expenditure programs of 3,500 crores in next 6 to 8 months. Part of it is already completed, where we have largely implemented the sugar expansion plans. And chemicals will get completed, and even Fenesta will get completed in next 6 to 8 months. Now, that will definitely lead to a lot of growth in terms of volumes and new revenue streams. Now, see, we are generating cash close to about 1,200 to 1,500 crores every year, which puts us in a very sweet spot to continue to invest in growth, and which we'll continue to do more aggressively. And that's what our plan is, and we will do that in a more sustainable way.
Ruling out any acquisition?
Pardon me?
You're ruling out any acquisition, Amit?
So see, we are open to both organic and inorganic. So there is, it's not that we are not looking at inorganic growth. We are open to both.
Amit, you're also saying that you're expecting a lot of growth to come through, once all of these developments do go through in the next couple of quarters. So can you tell us then for FY24 what the revenue could look like, taking, all of this into consideration?
See, revenue will definitely see good growth in FY24, and I would say more in FY25 when we will have a full year impact. Because these projects, once they come in, they take time to ramp up. And there are a lot of new products that we're launching, and therefore they'll take time. So FY25 should be a good revenue year, as well as the profit year.
FY25 will be a good revenue year as all the expansion plans that you've put in place will come to a fruition. Thank you very much, Amit, for joining in. That's the word coming in from DCM Shriram. Get into a break. Up next, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next.